here are the clients that I'm going to be going over today. This is Sly Fox. He's up about 56% over the last 3 months. 28K on a 50K account. This is Adam. He's up 17.24K year to date over the last 7 months. And this is Emre, who's up 15.3K on a 50K account. That's about 30% year to date over the last 7 months as well. So who am I? My name's Kevin. I'm the founder of 5 Minute Futures. If you go to school.com/futures, you can join my community for free, and you can see all of these case studies in the wins column where I post them. So the plan for this video is I'm going to go over the baseline S&P 500, and then we're going to go over the third-party verified track records of these 3 individual clients, highlighting what their drawdowns were, what their returns were over the last 5, 6, 7 months, and also going over some of the most important metrics that I look for in a profitable track record. All the track records you're going to be seeing here today are third-party verified, meaning that they are linked up via brokerage integration. That's the only way to get on this website is to link your actual trading account, so you know that these results are actually real and not something that you can fake with like a sim or demo account. No, these are real accounts trading with real capital. So let's start with Sly Fox. So Sly Fox has been trading our portfolio. Let's take a look. So he really got started back in December of 2024. At one point, he was up 9.4K in January 2025. And we had a black swan event in February and March. So you can see his track record went down to the biggest drawdown at this point was 23.597. And then since then, over the past 3 months, he's just been doing an incredible job. And I'm going to be going over some of the reasons why his track record has been performing so well since April. So from April 7th, he was down 26K to today, July 26th. So this is basically 3.5 months since then. Not only has he recovered from that 26K drawdown, but year to date, he's actually up 9.39K. So he's made back 35K of the last 3.5 months. If we look at exactly 3 months, has been 28K. So let's do a quick breakdown of his Kinfo track record. So overall, obviously he's had the best 3-month performance, but let's look at some of these crucial points in his journey. The yellow arrow was the Q1 top for his equity curve. So you can see up until January 2025, his single best P&L day was actually this day right here, which was February 26th, 2025. And on this day, he was currently at that point up about 9.4K, right? So that's the first kind of milestone in his track record, which led to overall, we had 23.6K of drawdown as of April 7th. So that's the second biggest milestone that we see here. This red circle marks the worst part of that drawdown, which was April 7th. Okay, so he was down 23.6K. Now the third milestone here is break even. So when did he get back to positive territory? This was May 16th. So he had recovered the full 23.6K. Within about 5 weeks, he was back to break even. And then we can see this purple arrow here just marks where the current performance is, and it shows that he's currently up 12.1K. So if we look at the stats for a 50K account, overall, right, he's up 12.1K. That's about 25% year-to-date returns on a 50K account, which I believe is what he started with. This is basically the baseline that we use because everyone starts with a 50K account when they license our portfolio. Now, the PTV, the peak to valley drawdown, was negative 47%. Okay, so what this number is basically 23.6 divided by 50K. So that was our worst drawdown. At some point, we were down 47% in this account, which is, I'm going to be upfront with you, that is more risk than I'm comfortable with. Everyone has their own individual risk tolerance. I think what Sly Fox did great in this case was he continued trading the portfolio even though he was when you're in a drawdown this steep, sometimes a lot of traders will just turn off their strategies. But this is the worst possible time he could have turned it off, because if he had turned it off here, he would have missed out on this big 10K day, and then this big almost 7K day, and then this was another 10K day, right? So 3 days in April made up like 95% of the recovery during that period. So the drawdown was 8 weeks, and we recovered in like 5 weeks. But that only happens if we continue trading the strategy, right? So I think what SlyFox did incredibly well was, yes, we might have been over leveraged. For a 50K account, I think this is a lot of risk, but overall he continued trading, and since the last 3 months, I mean, this track record, I don't think it could be any better. Like, our portfolio is not, our baseline portfolio does not perform this well. So SlyFox is doing something very, very unique in that he's turning up leverage on some of the short strategies when he thinks that the markets are going to go down, and he's in other bullish periods, he will turn up leverage on the long strategies. But this is more like, you can't really copy and paste that across all the clients unless you design it as like a filter. So that's something that I think SlyFox is doing really well as a portfolio manager. He's calling the right shots. And I would love to know if that could be systematized and something that we could code, but I'm guessing a lot of it is just kind of doing technical analysis by hand or more speculative, so that's going to be pretty difficult to code, but I would love to code it if we could. So SlyFox, if you're watching this, let me know what you're doing to have such good results of the past 3 months, and if it's something that we can repeat, we would love to code that into our portfolio. So now that we've gone over one of the client track records, let's go over the S&P 500 as a baseline. So now that you have some more context, you kind of know what these colors are showing. So the yellow arrow is our Q1 top. The red circle is our Q1 bottom. Blue is break even. Purple is current. So if we look at these stats, the Q1 top was February 19th, 2025. At this point, the markets were up 4.58%. So that's right here. This yellow arrow shows where this is basically the last week where the markets were up before the drawdown began in February and March. And that drawdown went from February 19th to April 8th. So that was about 2 months, about 7 weeks, where the markets were just capitulating. And we got down to a low of 496. So that's about a 15.5 drawdown in the S&P 500. And if you look at the peak to valley drawdown, that would have been 20%, right? 4.58 plus 15.5. So this entire move here, from here to here, this was about a 20% move. So if you were trading during that time period, it's kind of scary. Everyone was kind of freaking out. They weren't sure where the bottom was. But we got back to break even in May. So from this red circle to this blue arrow right here, this was about 5 weeks. Took 5 weeks for the markets to recover and get back to 0% returns year to date. So this is the price that the markets started the year at, about 586, and then they got back to 586 on May 13th. So, 5 months of time in the markets, and people were basically break even, which a lot of people were thankful for, I think, in May to get back to break even because everyone was panicking. But this is where we're at right now. So this purple line, currently it is July 25th, was the last trading day, and we are currently up 8.71% year to date in the S&P 500, okay? And we had a drawdown of 15.3%, so our ratio is 0.57 to 1. For every dollar that we risk this year to date, in the S&P 500, we made back 57 cents there. So looking at SlyFox's track record relative to P&L to drawdown ratio, it was 0.52 to 1. So this is just under what the S&P 500 did this year. And the reason why this ratio is important is because if you want to scale your capital, P&L to drawdown ratio is basically the only metric, the most important metric that kind of matters, assuming that all of your systems are already built well. The reason for that is if you have $100,000 of capital and you're trying to extrapolate that to $1 million, then your ratio is just going to scale to the amount of capital that you have, right? So the way that we trade, at least, we could just change a 1 to a 2 and trade with double the leverage, which means your P&L will double and your drawdowns will double. So instead of making $12,000, if he had traded with twice the leverage, he would have made $24,000. But his drawdowns would also double, right? So the most important ratio that I look at really is P&L to drawdown ratio, because you want this to be higher than the S&P 500 if possible. But basically, the higher this ratio is, the better that you can scale your capital. If you have, let's say, 7 or 8 figures and you're just testing on a 50K account or 100K account just to validate the system, then you add in more capital. Generally, you want that ratio to be as high as possible. So let's look at another client here. So this is Fire King. He has been the most consistent client that's been trading our portfolio, and this is his kinfo. So he started back in January of 2025. So basically the start of this year, and you can see his journey. So he made 2K at one point in January, end of January. So he was positive his first month. And then we had the Black Swan event in February and March. He hit the bottom of his equity curve here, right around March 21st. And then we began recovering on April 9th. So he went from negative 14.6K to negative 3K. So that's about an $11.5 thousand day. And then he went from negative 3.6K to 11.8K. So that was a $14,000 day. And then he went from 6.9 to 16. That's another $8,000 or $9,000 day. And then most recently in June, he went from 7.1 to about 15.7. This was about he's at 17K currently, I believe. Yeah, 17.2K. So one of the most consistent track records. I think the most consistent. So one thing that Adam does just extremely well is he just trades the system without messing with it. And no wonder he has the best results year to date. Like out of all the clients, Adam might not have made the most in the last 3 months. He might not have had the lowest drawdowns, but Fire King has made the most amount of money year to date in total with this portfolio, with a 50K portfolio. So congratulations to Adam. If the most important metric is how much money we make, then Adam wins the cake on that one. So let's just quickly look at the stats. I think we already went over it, but Q1 top in January, Q2 bottom in March. He was down 16.5K at one point. And then he was back to break even April 26th. So from Q1 to break even, this is about, he was in drawdown for about 2 months, and then it took him about 4 weeks to recover back to break even. And as of April 26th, he was back up 11.8K from being down 16.5. So just think about that. He was down like 30+% in March. He made all of that back and then also became profitable in April. So he ended up making back like $29,000 within the course of a month, right? So yeah, that's most people's like annual paycheck, I guess, if that's one way to think about it. Most people make like 30-40K a year. So Adam made that in 1 month, and yes, he was down, but the way that trading works is sometimes we have 2 or 3 days that make up our entire year. So it's really important to just keep trading the system. And I think Adam demonstrates that really, really well. So this is where he's at currently. July 26th, he's currently up 17.2K. So on a 50K account, that's about 34.5% year to date. So compared to the S&P 500, 4.5% divided by 8.7. This is currently where the S&P is at. So he's done about let's just call it 4. He's done about 4 times better than the S&P 500 this year. So that $50,000 that he put into this, he did 4x what he would have gotten just putting that in the S&P 500. And of course, the reason for that is because there's built-in leverage in futures, right? And also our portfolio's doing pretty well. But the most important metric that I look at if we're trying to scale this up for Adam is the P&L to drawdown ratio. We want this to be, remember, the S&P 500, the P&L to drawdown ratio was 0.57 to 1. Every dollar that we risk, we got back 57 cents. With Adam's portfolio, for every dollar he risked, he got back $1.04. That's 2 times better risk-adjusted returns compared to the S&P 500. So the reason why this is so important is because if he decided to scale this up, right? He's trading with $50,000 right now. But let's say he traded with, let's say, $500,000, right? So his P&L over the past 7 or 8 months would have just been 10 times what he made with a 50K account. So he would have made $172,000. So I updated these numbers to reflect a 50K account. So yeah, if we just do the math, 8.71% on 50K would be 4.3K. And 15% drawdown on 50K would have been 7.6K. So let's say we 10x this, right? S&P 500 is pretty liquid, so you could just 10x this. Okay, so that would have been 43K on a 500K account. The drawdown would have been 76K. All right, so yeah, pretty good, right? 43K over the past 8 months, so the normal average American makes like 40 to 60K. So with a 500K account, you would have made the same as like a minimum wage worker, I guess. But here's the difference. With a 500K account trading this portfolio, everything just scales up, right? So instead of making 17K, Adam would have made 172K. His would have been obviously bigger as well. But this is also why that ratio is so important, because you look at 165K drawdown and you think to yourself, wow, that's a lot of money, right? But you would have made back 100. You would have made 172 year to date. So that's a 1.04 to 1 ratio. Whereas S&P 500 with that same amount of capital, sure, your risk would have been lower, 76K risk, but you would have only made 43.5K, and we know that ratio is about half of what Adam's ratio was. So this is why it's so important. This is why this ratio is so important. When you scale up capital, you just want this ratio to be as high as humanly possible, because the more capital that you have, the more risk that you're going to take on, but also the more reward as well. So that capital basically will dictate how much your risk-adjusted return will be. All right. So, yep, these are the screenshots. This is where I got the data from for Adam's track record. And last but not least, let's look at Emre out of Australia. So Emre is not only, I think, very consistent, but he's also had the best P&L to drawdown ratio out of any client so far this year. You can see he started his journey back in February 10th. So he's been trading for about 5.5 months. He was up 355 at one point in January, but his drawdown in February and March was very, very low compared to the rest of the portfolio of clients that we have. He was only down 6.9K, or that's about 13 or 14%. And he turned I believe what happened was he turned some bots down or turned them off during this period, because he has his own proprietary way of detecting like when the market is bearish or bullish. And Emre, if you want to share that with me, that would be fantastic. I would love to code that up and put it into our portfolio. If you have like something that can be coded and back tested, we would love to add that, because that's a cool part about algorithmic trading is you can basically code or backtest anything as long as you can define it in strict terms. The only thing that doesn't work is like if someone says, oh, I felt like the market was losing momentum and that's why they did it. That's not something that is observable, right? It's not an objective rule set that we can code. So if it is an objective rule set, we can code it and backtest it, and we would love to add it, since it improves performance by quite a bit, it looks like. So Emre turned his strategies back on April 7th. So he went from, at the worst point of his drawdown, he was down 6.9K, and he had recovered fully by April 9th. He's already up 4.7K. So he made back about $11,000 or $12,000 from end of March to second week of April. So very, very good call, turning the strategies off and on again. And he also caught this, I think the second biggest day that we had in our portfolio. He went from 5K to 13K. It's an 8.5K day. And then his all-time high on this portfolio was 20.75K. So that was back in May 17th, 2025. All right. So now one thing I will point out is, first off, massive, massive props to avoiding most of the drawdown here, right? Something I want to highlight is that, like, we look at his February and March performance, and he basically bottomed out or flattened out during that time period, and because he had turned off some of his strategies during that time. He's overall, he's up 15.36K, which is 30%, over 30% year to date. And the biggest thing that I want to highlight is his P&L to drawdown ratio is freaking amazing. 2.2 to 1. Right? His biggest drawdown was 7K. And like he was back to break even from May 15th to April 9th. He was already back to break even. So his drawdown period was really short compared to the rest of the portfolio. And he's still up 30% year to date, which means that his drawdown was less than 14%, and he's still up 30% year to date, which is incredible. So this ratio, 2.2 to 1, that is like S tier. That's basically as good as you're gonna get with this style of trading, I think, and the best that I can hope for. Typically, our profit factor is about 1.71 on average. So profit factor is a pretty close approximation of P&L to drawdown ratio. So our portfolio as a whole across like 19,000 or 20,000 trades is 1.7 to 1. So Ray beat that by a good margin. And I want to point out something like this style of turning off the strategies, turning them on due to like having some sort of speculation about the markets. If it's not systematic, like if you don't have a filter that is codable and backtestable, then it's not repeatable, right? So it would be pretty hard to just copy and paste this method to other clients that I have. If it's something that's more like doing chart analysis or something that's a little bit more discretionary. But also, I also want to point out that yes, the biggest drawdowns were avoided, but also I think some of these profits over the past month or so, Emre should have had. If we look at Adam went from 7.1K to 17K back in June 25th to July 1st. So that last week of June, Adam made 10K, and the last week of June, Emre made about 3K, right? So it's a double-edged sword. If you're gonna trade systematically, my thing is, like, I think a systematic trader should just take all the trades, and anything that we can do to minimize a drawdown should be done with code. Obviously, sometimes that's easier said than done, right? So I don't judge anybody for turning off the system. I think that there has to be a set of rules that you have to follow for what happens in scenarios where you're down like 30, 40, 50% drawdowns, right? I don't think that trading is just like, I don't think you should have infinite risk tolerance. That's definitely not the way that I trade. I typically like to aim for 20 to 30% max drawdown per year. That's like right at that perfect level where you can still recover from a 25% drawdown or 30% drawdown. You can still recover within a year or two. Side-by-side comparison of all three track records, we can see that SlyFox has the best 3-month performance with 28,000 or 56% of the last 3 months. He also had the biggest drawdowns, right? So obviously, whatever he's doing over the past 3 months has been working out tremendously. He's outperformed, not just the S&P 500, but our portfolio. You can see this equity curve is like very much straight up and to the right, which is what we kind of want. So 3-month best P&L reward definitely goes to SlyFox. Emre has had the best P&L to drawdown ratio, meaning he had the lowest drawdowns for the best overall P&L, right? So this is an incredible performance, 2.2 to 1 risk-adjusted returns, which is 4 times better than the S&P 500. Absolutely world-class. I don't think you can get any better than this when it comes to this style of trading. Overall, though, I think my favorite track record out of all three of these is definitely going to be Fire King's. So the reason why I say that is because Fire King, yes, he had a 1-to-1 ratio, P&L to drawdown ratio. Yes, he had some pretty big drawdowns compared to Emre, right? And his last 3 months, it doesn't look as pretty as SlyFox's, right? SlyFox made 28K for the last 3 months, and Fire King made, I think, 5 or 6K. But overall, year to date, he has had the best P&L. And I think the reason for that is he's the absolute most consistent systematic trader, which all that means is he doesn't make he just takes all the trades that the system has to offer, right? Whether they're losses or wins, he doesn't try to guess or speculate on which trade is going to win or which trade is going to lose. He just runs the system out of the box. And the reason why this is my favorite type of track record or favorite type of client track record is because I can replicate this in any account, right? I can't really replicate what SlyFox is doing here unless I know the rule set that he's using, and it has to be rules based and it has to follow very strict criteria in order for us to code it and backtest it. Same thing with Emre's. Like, I don't know how he avoided this drawdown back in February and March. He has some sort of discretionary way to tell. That would be something that we can't code and backtest. Obviously, I would love to do that for the portfolio. Is like, yes, we would all love to have lower drawdowns, but I don't know if I could replicate this across any client. I know for a fact, though, that this is the closest track record that we have to just taking every single trade, good and bad, which means that I can copy and paste this across any trader. Like, I could have given my grandma a trading account earlier this year and just had her put the same settings that Adam did, Fire King did, and she would also be up about 34% year to date with a drawdown ratio of 1-to-1, which is twice as good as the S&P 500. So the reason why I love this type of client so much is because I can just copy and paste this result into any trading account. And at the end of the day, that's all we're trying to do is just a product that can plug and play into any trading account so that any trader with a sufficient amount of capital can replace their 9-to-5 income with full-time futures trading and have it be automated so that they don't have to sit in front of a chart and have emotions all day. If you enjoyed this case study, head over to our free school community, school.com/futures. You can go over to the classroom section and click set up bots, and you can try all 75 algorithms that we have for free on a sim account, so you don't have to risk real money, and you can get started with this type of trading without having to go through hundreds and thousands of hours of development like we did. So hopefully you enjoyed, and catch you on the next one. Bye.